Hey everyone, Chad Pavel, CPA here. Let's talk about real estate. The simple maneuver of converting your personal residence into a rental property brings with it many different tax rules, mostly good for you though when you know how they work to your advantage. The first question that arises when you convert a personal residence into a rental property is how to determine the property's tax basis. And that's for depreciation purposes as you rent the property out, but it's also for the gain and loss purpose when you eventually go to sell that property in the future. So knowing these differences can save you or lose you a lot of money and even create some troubles with the IRS if you don't do them properly. Anyway, oddly enough, two different basis rules actually apply when you convert your home into a rental property. So let's say that you convert your home into a rental, and then 5-10 years later, you sell it at a gain. Your basis on the conversion date is the usual computed amount, which is the cost of the home. This is what you purchased it for, plus any improvements that you've put into the home, minus depreciation. All right. Now, if after conversion to a rental, you sell that home at a loss. So if you buy it for $200, put $50 into it and sell it for $175, that's a loss. Your basis on the conversion date is actually one of two things. It's either the lesser of the computed basis that we used in scenario one, or it's the lesser of the fair market value as well. So if the home actually has dropped in value, that would be your basis as well. So once you've converted a former personal residence into a rental, you need to follow the tax rules for landlords moving forward. And again, totally different than when you just own the home for personal residence use. So here's a quick summary of the most important things that you need to know after you convert that property. Number one, you can deduct mortgage interest and real estate taxes on your rental property. The next thing that you can do that you couldn't do before is you can also write off the standard operating expenses that go along with owning a rental property. And these include your utilities, insurance, repairs, maintenance, yard care, everything from from snow removal to lawn care, the association fees, anything that has to do with keeping that building up and running. That's a normal operating expense. And finally, you can also depreciate the cost of the property of a residential building over 27.5 years, even while it is, you hope, also increasing in value. So you actually get to write off a portion of the purchase price, which is a straight deduction on your tax return. Now, how about real estate rental losses? Well, if your rental property kicks off a tax loss, things can actually get a little bit complicated. And typically that means that you collect a certain amount of rent, but you write off even more, typically through depreciation and some of the other expenses that you incur. So this so-called passive activity loss rule will usually apply in that case. So in general, the passive activity rules allow you to deduct losses only to the extent that you have passive income from other sources, such as positive income from other rental properties or gains from selling them, or some other, again, passive income source that you don't actively participate in. There's a number of different passive activity sources, but eventually your property should start to show a positive taxable income instead of a loss over time, because the escalating rents will surpass your deductible expenses, and just in general, the property hopefully will increase in rentability. Of course, you must pay income taxes on those profits as they do kick in. But if you piled up suspended passive losses in earlier years, losses that you couldn't necessarily deduct in that year, you now get to use them in the future to offset your passive profits. So just because you couldn't deduct it in the past doesn't mean you can't deduct it in the future. Prior losses can offset future positive income, passive positive income. That's a cool thing. Another nice thing, positive taxable income from rental real estate is not hit with the dreaded self-employment tax, which applies to most other unincorporated profit-making ventures like consulting and independent professional services and most other businesses. The self-employment tax rate can be up to 15.3%. So it's a wonderful thing when you don't actually have to pay that on the income. And that's the good thing about passive income, is you don't pay that additional 15 or so % self-employment tax. The other thing is that your net rental profits may qualify for Section 199A deduction, and that could be a huge deduction on your tax return. Another good thing is that if your rental property rises to the level of a trade or business, your rental profits avoid getting hit with the 3.8% net investment income tax, or NIIT, as well. So the tax code clearly has been built to benefit property owners. Taxes when selling real estate. Let's talk about those. So when you actually sell a rental property that you've owned for more than 1 year, the profit, again, the difference between the net sales proceeds and the tax basis that we discussed before, the tax basis of the property, after you subtract out your depreciation deductions during the rental period, this is generally treated as a long-term capital gain, especially if you've held the property for 1 or more years. And that means that the rate can be much different and much to your benefit as well. Now, always keep in mind the good news here. You don't actually pay taxes on the property appreciation, on the rise in value, until you actually sell your property. So if you bought a property for $200,000 and now it's worth $1 million and you didn't sell it, you don't pay taxes on the $800,000 gain until you sell it. So remember those suspended passive losses we mentioned above. The suspended losses are actually ordinary losses. So when you sell a rental, you can find 2 great benefits that can really keep more money in your pocket and reduce your tax bill. First, gains are tax-favored capital gains. And then to the extent of your gains, you release suspended passive losses that offset ordinary income. So once again, those losses you took in the past come up to help you and reduce your tax bill in the future. Avoid paying taxes on real estate capital gains, and here's how to do it. Always keep this in mind. Rental real estate owners can avoid taxes indefinitely on gains during sale using Section 1031 exchanges, named after the applicable section of the beloved 70,000-page Internal Revenue Code. And here's how it works. The tax code actually totally mislabeled this 1031 exchange. It's really not an exchange or a swap, really in any way, but here's essentially how it works. So 1031 exchange rules. Think of it this way. You sell a property and you make a couple $100,000 in gain when you sell the property. Here's how it works. If you buy a new, more expensive property within typically about 6 months, your Section 1031 exchange intermediary, typically a bank, will actually handle the paperwork, and that will make the taxes go away. You don't pay taxes on the gain on the initial sale if you roll that gain into another property. Now, there's a bunch of different rules there, but largely that is true. Now, if you convert your home into a rental property and you'd like our advice on how to convert it properly and get the best tax treatment today, over the next 12 months, and obviously when you go to sell that property, give us a call, click a link. You'll see a link somewhere on this page, or if we're on YouTube, a link below, to go to our website and book a free consultation. We'll walk you through. Here's what happens when you sell your property. Here's what happens when you convert your property. And here's how to make sure that you're getting the best possible tax treatment so that you can minimize your taxes as a landlord and minimize your taxes as you become a super landlord and acquire more and more properties. Hope this helps. Again, I'm Chad Pavel. We'll talk to you soon.